Hello. So AMD just posted its earnings, and it looks to be rallying more than 10% right now, pre-market, with an outlook that blew past Wall Street estimates. And you will see here that AMD is also acquiring Xilinx on a $35 billion acquisition here, which is expected to close this quarter. And you will see, if you take a closer look here at the article, that for the current quarter, AMD said it expected revenue between 4.9 and 5.1, and analysts had forecast 4.35, and gross margins of 50%. The company is actually doing better than this, and this is pretty awesome. And we're going to take a look at the financials in detail, obviously, as we usually do, but it's good to see that AMD is growing nicely. The thing is, we want to examine whether the current stock price makes sense for us to enter the company, and actually buy some shares, because if we want to be making money out of our investments, we want to make sure that we're not buying very expensively, and we want to be buying something that's kind of fair valued or undervalued. It would be the best thing, really. And so we will be examining the financials of AMD in detail, basically right now. And so let's take a little bit of a closer look here. The thing that I really don't like about AMD here as an investment is the fact that it went parabolic, and when things go parabolic and like super grow in value very quickly, they tend to kind of go down. It's almost like a ribbon that goes up and has to go down at some point. And so it has gone down a little bit, but still it's very far from its base, which you can say that it's about here potentially. So, bear that in mind when you are investing in it, because it matters with investing and trading in some situations. So let's see what else here. So the outstanding shares of the company, $1.21 billion shares here. And the thing is, you'll see that stockholders have been massively diluted, because the company's outstanding shares used to be about 700 million, and they are now 1.2 billion. So massive dilution here. The company has printed a lot of shares here to fund themselves, and that's not great for investors. Very low short interest here. Still, though, 5.29 is not negligible. And 1 year growth and in price of the stock for 31%. That's really massive, despite the fact that the company's stock price has actually dropped a lot from its all-time highs. A PE of 36 is a pretty high PE as well, bear that in mind too. And the price to book ratio, that's massive too, is almost 20 here. Let's take a look at the actual financials though, starting with the income statement of the company, as it's actually right now at 11%, almost 12%. This is live. This is after market, and pretty soon it's going to be pre-market. So, year-over-year growth here, that's increasing massively, with the last 12 months being at 71%, and same with the gross profit. And a very interesting thing here, the net income of the company, which grew from minus in 2017 to $4 billion in the last 12 months, which is insane. This is some fantastic growth in terms of the net income of the company. Let's take a look at the balance sheet. Two things that I like to examine here. First of all, I want to examine the total liabilities, see how many liabilities the company has, which is $4 billion right now. And also the total equity, which is $7 billion. It's more than the liabilities, of course. And it's growing very nicely from 500 million, almost 6 here, to 7 billion in 5 years, even less than that. That's a fantastic growth in terms of the balance sheet. Cash from operations, again, growing nicely and massively from 12 million to 3.2 billion. That's a very steep growth here. And you will notice that the last 12 months have been massive for the company, and I'm assuming this has to do with the semiconductors and the need for all of those, for many of those throughout the world, really, and the lack of them. Maybe that had to play a role with the insane increase in operating cash here. And cash from investing, companies investing as normal in some securities and capital expenditures, normal stuff. Cash from financing, for the most part, close to zero, but here they actually are repurchasing some common stock, so that's good to see. Finally, the company is actually purchasing some of its shares back, although I'm not sure if it's a great move, because the current stock price seems to be a little bit high to me. But okay, that's good for the current stockholders at least. And the free cash flow was negative since 2018, actually from 2017 to 2018, but then started to grow positive, and right now it's at almost 3 billion, which is a massive steep increase over here. Now, the interesting thing to notice is the fact that the company has $3 billion for its free cash flow this year, in the last 12 months. And if you remember it, we checked that it had $4 billion in terms of total liabilities. So it means that in less than 2 years, the company can actually repay back all of its debt. So this is amazing. They basically have no debt. You can kind of see that here as well, the total debt to equity very, very low over here. So the company has virtually zero debt, practically speaking, very little debt. And the interesting thing here now, after we are seeing that the company is really, really great in terms of how much money they're making, they are growing very nicely and all that. So that's awesome. And when the current market day pretty much begins, we're going to be looking at a company that has a stock price probably close to 130 here. It's going to be more than likely what's going to be. And this means that the market cap will probably be about 10% more than what it is right now, which is close to 155 or something of that sort in terms of the market cap, $1 billion. Now, for a $155 billion market cap, what are we getting in terms of the free cash flow? That's very, very important. Let's go back and check again. The free cash flow here was $3 billion in the last 12 months, and actually less than $1 billion in the previous year. And so we're looking at a company that has a massive multiple. So if we just take the last year, which is inflated when you compare it to the previous years, and we shouldn't really do that, we should be getting an average. But anyway, let's say that we're getting this value, $3 billion, and we give it a multiple of 30. It's $90 billion, which actually surpasses the current market cap of 155. Remember, it's going to be about. So we are looking at an overvalued company, even if we're getting a multiple of 30, really. And with this kind of market of free cash flow, $3 billion, we're looking at what, like maybe a 50? Yeah, it's about a 50x multiple, 50x free cash flow multiple here. Again, if we're just taking this current last 12 months, which I'm not really sure, it will be the same thing happening in the next couple of years or so, who knows, maybe. But compared to what it was doing the previous years, that seems very optimistic here. So we're looking at a company that has a massive free cash flow multiple here in terms of its market cap. So in this situation, while I love the company and I really, really like the amount of money they are making and their growth, I'm a little bit hesitant to enter in this valuation because I want to be adding companies to my portfolio that are a little bit cheap. And so if this company were to drop a little bit, I would definitely consider it, because there's always a price for everything. And I want to be buying things cheaply so that I can make the most amount of money possible from them and not pay more for what they currently are. Because remember, if you were to be getting, let's say, $5,000 in the next 5 years, like $1,000 every year, would you actually pay $5,000 today for this? No, because why would you pay the amount of money today and actually make the same amount of money in 5 years? You are paying $5,000 today to make $5,000 in 5 years. Now you would have to account for inflation, whether the company is going to be doing the same as it's doing now, and all of that stuff. And so it doesn't make any sense. You need to be paying much less. You need to be paying way less in order to justify investing. And so this is the same thing happening when you are actually investing in a company. You want to be purchasing the stock at a lower valuation, a lower price, so that you can actually be making money as the company is increasing its free cash flow. And you may be saying the company is growing massively. Yes, that's true. But why would you pay for what the company is probably going to grow like in 10 years? And you're going to pay for that now? Like what the company is going to be making in the next 30 years, why would you pay today? That's the question, really. And you have to, and you can say that the market is paying for that right now, but as an investor, again, you want to be finding the best opportunities for your money. And so if something is a little bit expensive or very expensive, you can wait it out. It may actually go down in price, or just select a different stock that makes more sense for your investment. Again, the company is great, but we need to be making sure that we're putting our money to work in the best opportunities possible. So this is what I wanted to point out here. And yeah, so in this situation, I would want it to go down probably quite a lot, actually, to be able to invest here. Probably less than 100, really, to see myself getting into this stock. If that happens, I will definitely create a video and we can discuss some more about it. But let me know what you think about it. Are you invested? Are you looking into entering AMD? What do you think about it? And if you like this video and you enjoy this kind of content, please subscribe and like it. And you may also want to take a look at our Discord channel. The link is in the description box below this video. We'd love to see you there. We're more than 10 people already. And we're having some nice discussions about investment topics. It would be nice to see you there. And thank you for watching this video. I'll see you very soon. Bye bye.